Hi, I'm Mark with Best of Us Investors. I've been investing for 40 years and would like to share some of my insight with you today. I'm not here to tell you what to invest in, but to provide you with some information that may help you become a better investor. Please hit the like button and also subscribe to the channel if you appreciate this content. Remember, this is for educational purposes and is not financial advice. Okay, let's get started. On his show Mad Money, Jim Cramer does a segment called Am I Diversified?, where viewers call in with a list of 5 stocks. Jim writes these down on his clipboard, studies them very carefully, and either claims that the viewer is diversified or not so much. In today's video, we're going to go over the principles of portfolio diversification and why it's important to have a diversified portfolio to grow your long-term wealth. I'll then show you a way to invest in one ETF that will give you diversification based on your risk tolerance. From my experience, most people interested in starting to invest in the stock market would be best to start off dollar cost averaging into an ETF. ETF, or exchange traded funds, are baskets of assets such as stocks or bonds that offer investors easy ways to diversify their portfolio. ETFs can either be actively or passively managed. Actively managed ETFs, such as Cathie Wood's ARK funds, attempt to beat their benchmark, while passively managed ETFs are designed to match their benchmark, such as the S&P 500 or the NASDAQ 100. ETFs can also become more specific and focus on small cap, medium cap, large cap stocks, or growth stocks versus value stocks. You can also find ETFs for sectors like technology, real estate, biotech, utilities, financials, energy, and much more. In addition, there are ETFs that can focus on specific countries or geographical areas such as Asia, Europe, Central America, Germany, China, India, Japan, Canada, and on and on. There are even ETFs that can 3 times short any major market, or if you're bull on a market, you can 3 times pro the market. As of 2020, the number of exchange-traded funds worldwide is over 7,600, representing about 7.74 trillion US dollars in assets. One of the largest and best-known ETFs is the SPDR S&P 500 ETF Trust. The ticker symbol is SPY, and we've talked about this several times on several of my videos. So, with so many ETFs to choose from, how do we start? I always look at what type of asset diversification will best suit your individual situation. So what is a diversified portfolio and why does it matter? A diversified portfolio is a collection of variety of assets that combine to reduce an investor's overall risk profile. Diversified portfolios may include stocks from several different industries, countries, market caps, as well as other investments such as bonds, commodities, and real estate. These various assets work together to reduce your risk of a permanent loss of capital. A diversified portfolio can also reduce the portfolio's overall volatility. A diversified portfolio should have a broad mix of investments. So what investments should you have in your portfolio? And what is the best percentage of each asset class for your portfolio to hold? Well, those are good questions. When I first started investing, I was told to subtract your age from 100, and that should be the percentage of your portfolio dedicated to stocks. So if I was 20, and that was a long time ago, that would mean I should have 80% of my portfolio in stocks. Now, you can use whatever rule you like because everyone's risk tolerance and investment horizon is different. The basic premise is the younger you are, the more risk you can take, because if the market dumps, you have more time to make up for your losses than someone who's close to retirement like me. Stocks and bonds are common assets we think of when constructing a portfolio. However, there are other assets you may wish to include, such as bank CDs, precious metals, real estate, cryptocurrencies, rare coins, or maybe paintings, sculptures, or rare books. In addition to my investment portfolio, I also have real estate, farmland, and vintage cars included in my portfolio of assets. For this video, we'll focus on basic equities and bonds. So let's take a look at some historical risk-return data on a variety of portfolio allocation models. This information was provided by Vanguard and represents market performance from 1926 to 2018. So here we have a chart, and this is provided by Vanguard, but it was on the Motley Fool. And this is from over 93 years. You can see that if you have a portfolio mix where you just had 100% bonds, Okay. Your average return is 5.3%. Your best year, you're up 32.6%. Your worst year, you're down 8.1%. In 14 out of 39 years, you had a loss. That's 15%. Now, if you want 80% bonds and 20% stocks, you're bringing your risk up a little bit more, but you can see that your average return's up a little bit more. Your best year was only up 29%. Your worst year was down 10%. And you had 13 out of 93, which is 14%. So it's about the same as 100% bonds. Then you move into here where you have 40% bonds and 60% stocks. Your average return starts to go up, okay, and this is over 93 years. Your best year, 36.7% up. Your worst year, down 26.6%. So 22 out of the 93 years, which is about 24%. So that popped up a lot because now you're in 60% stocks. When you go to 20% bonds and 80% stocks, you can see your return has gone up to 9.4%. 24 out of 93 years, which is 25%, you see a year's worth of loss. So you can see how time goes. The longer your time is, the better off you can do. You don't want to get caught in a 4 or 5 or 6 year loss cycle, especially when you're getting older and you need the money. Now, if you want 100% stocks, which a lot of younger people can do, your average return is about 10%. Your best year, you're up 54%. Your worst year, you're down 43, which today would be tremendously hard on people. So 26 out of the 93 years, you had a loss, which is 28% of the time. So you can see during this chart that stocks, as you go with more risk, there's more reward, okay, but there's always higher risk. So the key takeaway from this chart is more risk, more potential reward. Bonds are considered least risky with lower expected returns, while stocks are considered more risky with higher expected returns over time. If you have a long investment time frame, then you may want to have more stocks. If you're about to retire and are concerned with wealth preservation, then a less risky portfolio may be best for you. So with all these investment choices, how can someone easily construct a diversified portfolio that is aligned with your particular risk tolerance? Luckily for us, Ishares by BlackRock has developed 4 ETFs that may help you get started. These funds are called allocation ETFs. So basically, they use 7 different iShare funds to construct a diversified portfolio within one ETF. These 7 iShare funds represent the following assets. The first is the U.S. bond market. They use the IUSB. Top holdings include various U.S. Treasury notes and bonds. Number 2 is the S&P 500, the IVV. Top holdings in the IVV include Apple, Microsoft, Amazon, Google, Meta, NVIDIA, Berkshire Bee, and United Healthcare. The third fund they use to construct your diversified portfolio would be the International Bonds Fund, which is an IAGG. Top holdings include an assortment of Chinese and Japanese government bonds. The fourth is the International Developed Markets, which is the IDEV. Top holdings include Nestle, ASML, Roche, LVMH, Toyota, Novartis, and Novo Nordisk, along with AstraZeneca, Sony, and Shopify. Fifth is the Emerging Markets Fund, the IEMG. The top holdings are Taiwan Semi, Tencent, Samsung, Alibaba, Reliance, Infosys, and JD.com. The sixth fund is the S&P Midcap, the IJH, where top holdings are Molina Healthcare, Camden Property Trust, Builders First Source, Massimo, Medical Properties Trust, and Graco. The last fund is the S&P Small Cap, the IJR, which includes Omnicol, Chart Industries, Watts Water, Max Linear. Then they have a cash fund for storing short-term cash. These 8 funds are included in each of the allocation ETFs in different percentages, which in turn is directly correlated to a level of risk. So the allocation ETFs are, number 1, the AOK, which is a conservative allocation ETF. This has the least risk. Number 2 is the AOM. It's a moderate allocation ETF. This has moderate risk. Number 3 is AOR, the growth allocation ETF. And number 4 is the AOA, the aggressive allocation ETF. This has the highest risk. So let's take a look at each of these ETFs. So let's take a look at each of the for ETFs that would give us a diversified portfolio based on different levels of risk. We'll start with the Core Conservative Allocation ETF. The symbol is AOK. Okay, this is the least riskiest ETF that you can get into. Now with the AOK, you're going to get about 70% in bonds and about 30% in stocks. So with that, it's less risk, but it's less return. So you can see since inception, you'll get about 5.83% annually. Moving up one level of risk, the next ETF for diversifying your portfolio is the Moderate Allocation ETF, and the symbol is AOM, or the ticker symbol. In this particular ETF, you can go down to the holdings, you'll get about 60% bonds, 41% stocks. So the risk level is coming up just a tad bit more. Your return comes up a little bit more too, so you're about 6.82% on your return. And again, it's using the same 7 core funds in each of these ETFs. The next highest level of risk is the Ishares Core Growth Allocation ETF, the AOR. And again, you can see same 7 funds here. In this particular ETF, you're going to go to 40% bond and 60% stocks, okay, based on the same funds. Your level of risk has increased, but so has your level of return. So the level of return on these particular funds is 8.76% since inception. Our last fund has the highest amount of risk. It's called the Ishares Core Aggressive Allocation ETF, ticker symbol AOA. In this particular fund, you're going to have about 80% of your allocation to stocks, 20% to bonds using the same 7 ETF funds. And of course, with more risk comes more return. So since inception on this particular fund, we're gaining about 10.76% annually. Now, if you didn't want to use any one of these 4 funds, basically, to build a diversified portfolio of ETFs, you could come to the iShares webpage and go to their core page, and you could build your own basic ETF. You could choose from the S&P 500, aggregate bonds, small caps, emerging markets, mid caps, total U.S. stock fund, and divide it up the way you like it. I've always liked, basically, for myself, this iCore Total U.S. Market Stock Fund as my base, the ITOT. And then I would throw in some DGRO, which is the iShare Dividend Growth Fund, along with the U.S. Aggregate Bond Fund. And with those 3 funds right there, you could put together a diversified portfolio using 3 basic ETFs. Now, you can go and look at all the ETFs and make up your own mind. Don't follow what I say. I'm just giving you an idea of how I've done it in the past. Now, I'm just using the iShare products as an example because I'm very familiar with their ETFs. There are several comparable companies such as Vanguard or Fidelity that offer other fine investment products also. So look around and find a company that works for you. For me, ETFs provide a great way to construct a low-cost, highly diversified portfolio. You can either try one of these allocation ETFs or build a portfolio of your own. Be sure to investigate all the ETFs you may use, as many of them have the same stocks within the fund, and that would make you less diversified. A proven strategy to increase your wealth over time is dollar cost averaging. Let's say you received $1,000 as a graduation gift. After completing your due diligence, you decide to invest that money into the iShares Aggressive Allocation ETF, the AOA. Then each paycheck, you invest an additional $50 into the fund. When the fund is down, you're buying more shares. When the market is up, but you're buying less shares. Historically, over time, markets go up. You'll be surprised how quickly your wealth will begin to grow. And that's my goal, to help you build wealth over time. Remember, always do your own due diligence prior to investing in any security to make sure it fits within your time horizon and risk tolerance. And also, don't invest something that's based on hope. Hope is not a strategy. Know what you own. Please hit the like button and subscribe if you enjoyed this content. Thanks, and we'll see you next week.